Welcome to the Compass series of conversations with leaders in impact investing, and thank you for joining us. I'm Ben Thornley, Managing Partner at Tideline. I'm excited to be talking today to the team at JP Morgan Private Bank behind the creation of the $150 million Global Impact Fund, and to two of the managers the fund has backed, Trill Impact and Elevar Equity. Before we get started, please know that we welcome and will reserve time for questions, which can be submitted through the Q&A feature in Zoom. The impetus for today's call is the joint publication by JP Morgan and Tideline of a case study on the Global Impact Fund, and specifically the focus in that case study on a resource called Impact, which stands for the Impact Assessment and Contribution Tool. Impact is the tool that, alongside JP Morgan's traditional due diligence process, is being used to interrogate and ultimately to score funds on the basis of impact, providing a rigorous and consistent way for JP Morgan to compare and contrast among managers operating in different sectors and stages of investment. Tideline is proud to have helped JP Morgan create the impact tool, and we've been privileged over the years to work with many other allocators in impact, beginning with Ford Foundation and continuing more recently with Temasek in Singapore. However, allocator practices in impact fund diligence remain relatively underdeveloped when compared to the progress being made by managers on company-level impact diligence, which is why JP Morgan and Tideline felt it would be timely to share the Global Impact Fund's approach as a roadmap for others to learn from. On the subject of learning, I would be remiss not to recommend Tideline's sister company, Bluemark, to your attention. The most important framework to be aware of for fund impact diligence is the operating principles for impact management. And as the leading independent verifier of investor alignment with the operating principles, Bluemark's benchmarking and thought leadership are invaluable. We'll begin today's session by focusing for 15 minutes on the Global Impact Fund and the impact tool, talking with two leaders from JP Morgan, Jessica Matthews and John Ancona. We will then turn our attention to the implementation of the fund in conversation with those that have been subject to JP Morgan's diligence process, at which time I'll introduce P.I. Rel from Trill Impact and Ami Patel from Elevar Equity. So now to welcome the JP Morgan team. Jessica Matthews is Managing Director and Global Head of Sustainable Investing at JP Morgan Private Bank and has been a pioneer in impact investing since the term was coined more than a decade ago. I go back that far with Jessica when she led Cambridge Associates' impact investing practice. Jessica, I'm so thrilled to have you as part of the Compass series.
Thanks, Ben. We do go back that far. Fun to be with you.
John Ancona is Executive Director and Head of Private Equity for JP Morgan Private Bank's Private Investments Due Diligence team. He's been a member of that team since 2009. Thanks, John, for joining us as well.
Thanks, Ben.
Jessica, to get us started, can you tell us a bit about the Global Impact Fund, where it sits at JP Morgan and what motivated JP Morgan to create the fund?
Sure. Thanks, Ben. I actually just want to start by having a little laugh about John and I sitting next to each other, crammed next to each other very closely. About 5 minutes before the call, we realized the beautiful room and the screen that we were in was not going to work out. We were further apart and it had a much better angle. So here we are on the iPad. It's 2021, and this is how we roll with it, with virtual meetings. So anyway, that aside, we're so thrilled to be part of this call. Thanks to Tideline and everybody, Ben and your whole group, for the great partnership. It's important to think about the context for why we came to this fund. John and others on the private investments due diligence team here at JP Morgan had really been deploying, impact funds from going back to 2012, I think. And those were kind of more single offerings. We were thrilled to have some of those on the platform. It includes Ami and the Elevar team. But we received feedback that perhaps a more of a fund of funds approach might resonate. You could theorize about why clients were a little bit on the sidelines with some of our private impact offerings. There was, nichier strategies, a little unfamiliar, a lot of venture, not necessarily all venture, but a lot of venture. Some of our clients may be a little bit more reticent there, a number of reasons, but we just didn't feel like we were seeing maybe as widespread adoption of impact in the private markets as we were seeing more in some of our public offerings. So we decided that this fund of funds approach, coming into 2020, this was the idea we had, that we would try this out, and perhaps this could turn, which we hope it will, into kind of our flagship offering around impact. So thus began the partnership with Tideline in early 2020. And as we'll get into lots more details on the call, we coalesced around three basic themes: inclusive growth, climate solutions, and health and wellness. And we launched the Global Impact Fund in September of 2020, closed on $150 million in March of this year. And it sits, it is available to the private banking clients of JP Morgan. And so that is a little bit of background, and we'll dig into the details a bit more.
Right. Thanks, Jessica. And John, how is the Global Impact Fund different to other vehicles that you've launched off the private bank platform? And what prompted you to want to create impact as a tool for impact diligence specifically?
Yeah, absolutely. I think, as Jessica said, we have done the occasional impact investment dating back to 2012. Actually, one of the ways we ended up working with Tideline, Christina was part of our efforts in 2012 with what's now Adjuvant Capital. So we've had a partnership kind of over the years. But I think my team is very used to underwriting financial investments, the single bottom line. We had a lot of help, obviously, from Jessica and her team in sustainable investing in terms of, thinking about impact. We've done the occasional impact fund, but we never codified that in any sort of way. And I think as we were embarking on this journey, having some sort of authenticity and credentialization around it, beyond the sort of Potter Stewart, I know it when I see it test, that was really, really important. That's why we, started on this mission. The Global Impact Fund literally started with interviewing Tideline and a bunch of other folks to see, how would we decide what funds were eligible for this vehicle. Having the impact tool now, I think I was maybe a little skeptical from the get-go. I was brought into it, but beyond that credentialization, it actually has been a really powerful tool. There's something about having a checklist. It's this sort of cognitive net. As we've scaled up, if I was looking at one fund, I'd be able to evaluate and keep everything in mind. But when we have a portfolio of 8 funds, having that reminder of, have we looked at all of these different dimensions? Have we considered the implications of this to really determine if that's impactful? That's been really valuable. The other thing I would say is the uniformity of that analysis. My team's about 20 people. Josie Fair, an associate in our team, and myself really led the charge on this, but we had other folks helping along. When we turned to Ami later, we have a team member based in India and one in Hong Kong. For reasons of geographic proximity, they did a lot of the hard work on Elevar. And having them apply the exact same consistent tests that Josie and I do in New York, a tool like Impact really enabled us to do that.
Great. John, can you talk us through Impact? What's in it and how it works?
Sure, absolutely. So it's a great strategic tool for us. I would say it starts with the screening, right? Asking a couple of basic questions of, do we think this is an impact fund? And I think that was, a lens that was really, really helpful as, we started building a portfolio and just sourcing for a portfolio, being able to put things aside early on of, well, that's a thematic investing, that's ESG screening, but it's not true impact. But I think the real sort of bread and butter of it comes in as we're diving with the manager. So screening on 3 broad dimensions: strategic intent, ESG plus is kind of a broader category, and then assessing the impact integration. It's been interesting applying it. Different managers score very, very differently, and I think it was important for us that it wasn't a tool that said, oh, you must have this to be a passing grade. Obviously, if someone scored low in all dimensions, that would be a real difficult underwrite for us. But being able to build a portfolio and knowing that some of our managers, were excellent in one of those arenas and scored lower in another one, but a different type of manager with a different focus might have excelled in some different area. It helped us to build a portfolio. It also helped us to know, I think diligence is an iterative process, and being able to go back to managers and say, here's what we found, here's what we'd love to see, help us get comfortable with this. I think a lot of our underlying managers know not just that we're really excited to be their LP, but also what LPs like us expect and are going to expect increasingly going forward, as these are planned to be long-term partnerships with all the funds we've underwritten.
Right. Jessica or John, where did you land with the fund? Like, which managers are in the fund? Why did you select them for inclusion in the fund?
Yeah, maybe I'll let you take that one.
Sure. I think one of the things that was a real guiding light for us, from the get-go, before we even sourced an individual manager, was building a diversified portfolio. Primarily developed markets, US and developed Europe really make up 85% of the portfolio. And similarly, having a heavy weight towards buyout, 51% of the portfolio is in buyout. I think one of the challenges there is buyout can do really well on some of the KPIs of impact, but some of the strategic intentionality, it's there, but it's very different from a sort of change the world type of venture investment. It was important for us to have that component, though, because this is the first flagship impact commingled product that we've had. And we wanted to do it in these sort of, a well risk adjusted way. There's some great venture funds included, but we recognize there's risk associated with them. And the idea of taking all venture risk was just really, really difficult for us to get our head around. So, 8 underlying managers. One of them we're just wrapping up diligence at the moment. Trill is a great example of an underlying buyout fund. We have one in the US as well. One sort of mid-market US fund, and one a little bit upper middle market. A growth fund in the climate space. 3 or 4 underlying venture funds in ed tech, as well as climate. Healthcare was the one area that we really wanted to have thematically. If you think about our impact dimensions, really mapped to the SDGs. A category called inclusive growth, which would be workforce, ed tech, job creation, all those sorts of things. Climate solutions, which kind of is what it sounds like, and then health and wellness. It's been interesting for us. I think health and wellness has been the most difficult to source for, because I think we took a view that just being invested in healthcare didn't make you an impact fund. Not everyone might agree with that. And so really we've gotten it through some of our more diversified managers, a Trill, for example. Maybe Pia will talk about some of what they've done in healthcare, rather than having any direct dedicated healthcare player.
Great. And I mean, you may have already answered this question, John, but did the impact tool do what you needed it to do in the final analysis, and when you were going to the investment committee and asking for approval for the funds that you've deployed capital to?
Absolutely. I would say it was really helpful for us as a diligence team in sort of assessing how we thought creating a common language for understanding across the team, and forcing us to, be really quantitative about it. I think one of the difficulties for us as diligence people is we spend a lot of time talking to each other, which is great. That's our job. But we have to come to decisions and say, this is more than that, or, set a specific level. This tool was really, really helpful for that. But above and beyond that, it was also helpful for articulating to our investment committee, who, our investment committee looks at impact funds, but they also look at regular way funds and mutual funds and hedge funds. It's a, broad across asset classes for the private bank. And so being able to give them a tool and a framework for thinking about, this is how we define impact. This is what we're looking for. This particular fund that we're presenting to you, does it meet that test or not? Keep us honest, hold our feet to the fire. It really worked on multiple dimensions there.
I'd add too there that, it worked for us internally because, I think we told you from the very beginning, we needed this to align with how John and team do due diligence. And so there was a little bit of an internal focusing, like this needs to work for us. And we outlined this in the case study. It was also important for us to look externally and say, but is what we're going to do align with standards throughout the industry? And furthermore, and I think we'll get into contribution a bit, but kudos to you, Ben, and the team, because really forcing us more to think about what would our contribution be to the market around this. And so I think that was some of the additional layers to this, beyond we'll know it when we see it, all of what John said, and some of these other factors about thinking about how we would present this really to the marketplace.
Well, Jessica, speaking of JP Morgan's contribution, I know that diversity was an important priority for JP Morgan and backing diverse managers. Can you talk a little bit more about that? And are you happy with where you landed in the Global Impact Fund on that?
Yeah, I mean, absolutely. If you look through, the whole entire framework, which is comprised of sub-indicators, we put a huge emphasis and sort of weighting to this notion that we wanted to make sure that this fund was invested with diverse managers. And we looked at that through the lens of both ownership and also, who the portfolio managers and executives themselves. And so, where we landed in our very first, out of the gate is at 49%. of the fund is allocated to diverse managers. And so, yeah, I mean, I think we do feel good about that. There's more work to be done there, and maybe hopefully that's the starting point, and further funds where we come back with this go further on that. So I think we do feel good about that. We made a real emphasis about it, and as we get further into maybe more of a discussion of contribution, I think that's a great example of it too, because the managers see how important it is themselves. And we've already had an example of a manager who went back and extended its own diversity based on recognizing our questions and the importance of it.
The only thing I would add to that is, I think the same way we think of impact as a catalyst, right? Elevar would talk about, maybe Ami will talk later about their capital bringing other investors into the space. Some of those tools we derived around how do we ascertain whether someone is a diverse manager, right? It's not as simple as just looking at them sometimes. You have to ask and be a little bit more scientific about it. We've extended that across the platform. And so not just applying it to smaller impact funds, but using some of those definitions more broadly and evaluating our platform is something which is really helpful today, and I think will serve us well going forward.
No, that's fantastic to hear. Well, it's my pleasure now to ask Pierre and Ami to join us on the call. Trill and Elevar are two managers that are part of the Global Impact Fund. Pierre Rel is Impact Partner at Trill Impact and a member of the Investment Advisory Committee. Thanks for joining us, Pierre. Ami is Managing Director at Elevar Equity, where she manages and cultivates the firm's global partnerships, including LP and co-investor relationships. So thank you, Ami, as well for joining us. It's great to have you both here. Pierre, I hope you don't mind if we put you on the spot and ask a fairly direct question of what it was like for you at Trill to be diligenced by JP Morgan, recognizing that at the time it may not have been obvious to you that the impact tool was sitting behind what JP Morgan was doing, but nonetheless would welcome you just sharing your experience of going through that process.
Thank you. Happy to share, and even though we were not aware of the model per se, we could absolutely understand that there was something more structured behind how they were actually putting their diligence questions and their systematic approach to asking us around the people, the strategy, our ambition, and so on. So my feeling, and just reflecting back now, it was a little bit while ago, on how it was structured around dividing ESG matters versus impact matters. And I think that when you come to that level and understand like your operational efficiency related to environmental, social, and governance questions, you really divide that from the wider impact doing good in your offering, then you're talking to more of a mature impact investors, and that's what we saw in JP Morgan in their way of asking questions and diligencing us. At the same time, of course, they wanted to have the house in order, so to say, in terms of how we organize ourselves, to the questions around the diversity, to what kind of frameworks, etc., that we've been using from sourcing, investment, how our IC committee is populated, and how we're onboarding and measuring impact in our companies. And I would say I appreciated the dialogue, and also I think when we started the process and the dialogue, it becomes more obvious what kind of frameworks that you wanted to use on a global level. So when Trill Impact started out, we used the impact management project to relate to, and that also helped that we have kind of a fundamental view of how we look at impact. And I think that's been a problematic area before, and listen to Jess again and John, how they explain their internal dialogue of how you need a framework in order to work effectively and be able to compare assets. And I would say that we have experienced the same thing in our journey in trying to put the same way of thinking around model and quantifying and being able to benchmarking on the impact side as we do on the financial side. And I think that helps in the dialogue with JP Morgan, for example, in their due diligence. So yeah, I would say that I appreciated it. I as you said, I didn't know exactly what was behind it. I could see that it was maybe a bit more structured, well thought through, and some quantifying model behind it, obviously.
Are you, Pia, seeing from Trill's perspective more LPs developing specialized impact diligence capabilities? What's your view on the state of the market?
I think it varies a lot, but I can see a definitely more mature way of having the dialogue, both with if a fund have a dedicated impact or ESG analyst. I could see that it's not only that part of the team that can ask these kind of questions. It's actually the entire team, but it also might come back to what kind of Trill Impact is, what kind of firm we are, and we were founded by the purpose of doing impact through value creation and value creation through impact. So that's how the firm come together, and I think that also, of course, attract investors like JP Morgan in where you can see that is a full balance between impact and ESG, and that's how we have put together the fund in terms of how we have designed a team, how we have recruited people, how we have our incentives, our carry linked to impact, and how we actually use our credit line and our LBO financing also to get the discount or a rebate on the financing by meeting certain impact targets. And I think this dialogue and these kind of questions actually came up in our dialogue with JP Morgan.
Thanks, Pia. Ami, Elevar is a very experienced impact investor. I know the firm was established maybe more than 15 years ago now. So you've seen the growth and evolution of the market over time. And I wanted to ask you how you'd seen LP impact diligence practices evolving as well, having seen them so many years ago and to where we are today.
No, thanks Ben, and thanks everybody for inviting us to be a part of this discussion. It's great to see how much progress has been made on the JP Morgan side with regards to developing this framework. Ben, you're right. We have been around for more than 15 years. And when we started, it was to prove that you could invest in an underserved low-income population and create both impact and financial returns. And the early LPs were really just wanting to prove that concept. There wasn't any sort of rigor or anything behind it other than to sort of get in. And then as we've evolved with each fund, there was still a good portion of LPs that I'll take what Jessica just say, we'll know it when we see it sort of approach, like our way of thinking about aligning impact with financial returns and business models. We've evolved that story and we've come up with the proof points. But what we've seen over the last two funds is that the level of questions has definitely sharpened over time. But so has the degree of financial return diligence and the need for being institutional quality as we grow as a GP. And so finding all pillars of both the impact diligence and the ESG diligence, the financial diligence, and then the operational diligence, there's a wide range of LPs that bring a level of sophistication for each of those pillars. And I'd say there's still a lot of room for improvement on the impact underwriting side. Most of our LPs have been proclaimed impact investors, but now as we foray into a new set of LPs that are coming from much more institutional underwriting, how they're entering into the space and what they're bringing to the conversation is definitely, there's a spectrum there.
And one of the name of the tool, impact assessment and contribution tool, brings forward this concept of contribution, which we've touched on. And I wanted to ask, when we talk about contribution, we're talking about JP Morgan's contribution, by the way, to the success of underlying GP. So I was just going to ask you, I mean, is it clear to you what your LPs, and JP Morgan among them, can be doing to help support Elevar's success? Like, what does an LP contribution look like from your perspective?
Yeah. To plug a little bit of the relationship that we developed with John, I have to say that they came in with their underwriting process and really understood Elevar and our core thesis from the very beginning, and probably asked some of the smartest questions around the business models that we're investing in and how they delivered impact and that financial return. So when I think of contribution and what LPs can be helping to elevate those of us that have been on the true impact side, is there's three, and some of it is consistent with what they've outlined as their sort of impact framework. We've always wanted to have capital that signals to other institutional investors that this is a good investment to make. And we've always had dedicated impact LPs, but I think bringing on JP Morgan into that mix helped elevate that story and brought that institutional quality stamp of approval, as well as validated the impact that we're creating. I think it also just helped to understand our strategy and elevate that story to an entirely new audience of investors, which was extremely beneficial for us. And then being able to deepen our relationship with that base, as well as some of the new institutional investors that followed JP Morgan, was being able to just have a more consistent, sticky base of capital providers behind our strategy.
Great. John, Jessica, just to follow on Ami's comments about contribution, I'd be interested to hear from you all on how that aspect of impact has been working, and whether the use of impact as a tool helped to identify gaps in GP practices or other areas where you could in fact make a stronger contribution. So if you could talk a little bit about the contribution aspect.
Yeah, I might take a stab at it. I would say that it really starts with a mindset change, right? I've always viewed, I'm an LP in a lot of funds, but the L stands for limited. And so we've always viewed it as this kind of one-way street of, we hand the money over and then, we expect returns over the next 5 to 10 years. We have ongoing monitoring, involvement, all that, sure, but never really viewed it as a two-way street. There was something you said to me, Ben, during our process to create the impact tool, that what we were trying to create here was not a fund of impact funds, but was an impact fund of funds. And so there was something additional we had to do to be able to justify that. And that had never really clicked for me until that moment. And so I think the act of going through the impact assessment, grading Pia without her knowing it, we're still doing that process as we've always done, now with a tool to help us. But we're also adding some stuff in there about what can our own contribution be. And there's an intentionality of, knowing that I can serve as a reference for some of their LPs, knowing that I can provide co-invest capital, knowing that we can, try to bring our managers to, get them in front of some of our clients, raise their profile in the industry, all those sort of signaling things Ami talked about. There's just not to say we would never have done that beforehand, but going in with this viewpoint of, we want to do that. We're going to look for opportunities to do that really are intentional in their own way. That was a real sea change, at least for me.
John, what were some of the nuanced findings that came out of using the impact tool? We had a good question from Adam related to the kind of information that surfaced at the investment committee as a result of having used impact. Like, what was some of the sort of detailed insights that emerged and that you were then able to action, through your selection of the various managers?
Yeah, maybe the biggest thing that we've seen, and Jessica, you should jump in too. The biggest thing we've seen is the difference based on type of manager. Like with Elevar and Trill here at the table, the difference between venture and buyout is pretty substantive. Venture on the strategic intent basis tends to score very, very highly. Whereas buyout, I think, lends itself a lot more to impact, integration, ESG plus, because there are KPIs associated with portfolio companies, with a company that Elevar might be founding effectively, or backing the entrepreneurs, the first institutional capital. There's high strategic intent there, but it is harder to measure because that company is literally, in sort of the early throes of its life. where some of these other companies do have operating metrics. I think, the approach we take is not to say one of those is better than the other, is to say that, we need both of those, but the way we can be contributory to our underlying managers is different, right? For someone like Elevar, providing co-invest capital might be really relevant. Trill doesn't need our money as a co-investor, I suspect, although we're happy to look at anything. But there are other things we can do there, encouraging them, reminding them of some of the impact sides. They've got a great team that's come from a lot of EQT, big private equity funds. They don't need my help on that. I don't know that they really need my help on sort of the impact authenticity either, but we've had some really productive discussions about, okay, how are you going to set, your impact carry, and how does that work? And how do you distinguish between what's ESG and what's additional above and beyond impact? Those are the sort of conversations that, this impact tool really gave us that framework to even just start to have.
And I think it was fair to say that there wasn't, you referenced this earlier. If everything was coming up low, this wasn't going to be included in the fund. But it's not as if everybody's just high across the board. So there was a lot of nuance baked into that. I think back in the day, John alluded to this, an impact investing definition was like the company receiving the money provided a service or created a product that in and of itself had impact. You knew what it was. And I think that's evolved. And so this framework has allowed us to think about what an impactful strategy looks like when the widget isn't necessarily like, the solar panel, and thinking more holistically about that.
Well, I'll give you a great example. So Two Sigma is our US buyout fund, Two Sigma's impact story. And what's interesting about them is their impact story is exactly that. Not I produce a widget. Sometimes they do produce widgets that have high impact, but it's really more around the workforce side. And that was a little bit mind-bending for us, thinking about, well, is that enough? Is that true impact? How do we get our head around it? And having a framework to express that on sort of common denominator terms with a Trill and Elevar, some of the other funds, just was a really, really useful framework.
Right. I want to make sure I give Pierre and Ami the opportunity to respond to John, what you shared about the venture capital model versus the buyout. Ami, Pierre, did that resonate, that perhaps in venture capital it's easier to identify the intention? There's a clear sort of thematic play that's going on in most cases, I can imagine. And then Pierre, for you, is having a more generalist strategy in some respects. Does that therefore sort of up the ante in terms of the robustness of your kind of impact management practices? I'd love to, maybe, Ami, I can start with you and then we can go to Pierre. Yeah.
Sure. So I think it's safe to say that not everything that's tech related is impact, and not everything early stage that's creating something new and shiny for us to improve our lives is impact necessarily, at least not the way that we think about how we define impact at Elevar. It really does need to have that customer lens, that direct focus on value creation for the end customer, and then figuring out how that business model keeps it affordable and accessible for that customer segment, and then scaling that venture. And we've been able to successfully prove this. So I think, to John's earlier point, it's being able to have like-minded LPs that understand the baseline of what we want to create from an impact perspective, and then the additional intentionality we bring through the entrepreneur selection and the business model that we're backing, and then aligning capital to continue with that company's growth. And so sometimes it's being able to raise larger funds and having strong LPs that believe in your strategy and understand what you're creating, and the universe of companies that you're contributing to the overall ecosystem is important. But then also having that follow-on capital and access to a deeper bench is also critical. I do want to add one point to John and Jessica's earlier comment. I think for a long time, having been in this seat for a while, there's been a baseline conversation of what is impact and how should your practice be and what's the robustness. I think we're heading into the new era of everyone should already be at that baseline, and how do we elevate our thinking to have more transparency and consistency across managers. And so with a framework like this that aligns with other practices that are in the space, it helps just to clean up things and create lanes so that people can't just slap on a label, but there actually needs to be substance behind everything.
Right. Pia?
Yes, I would say I agree with Amy that we are now in a era of going beyond like basic impact, where you can call a lot of things impact, that it need to have a certain contribution, and sometimes like in ventures you have the whole company set up to do impact, while in buyout where we are active, maybe it's not so clear always, but we see that as an opportunity, that a lot of leaders go out and have quite impactful companies, but they haven't really crystallized out that they are selling like one of our portfolio companies. They have been selling cost efficient building automation, but when we talk to them, they are actually selling CO2 reductions, and just turning that perception and helping their customers to become more sustainable was really like an eye opener for them. So I think putting that framework and helping even very established companies to see their business with an impact lens, without actually not need to impact washing at all, but rather the opposite, but also make them more efficient in what they are doing in order to improve people and planet in different ways. And the way we do it and the pressure test our thesis is that we very early in the sourcing process, try to think about KPIs. So how can we measure impact in this company? And can we measure it in a meaningful way, saying that there is an unmet need in the countries where this company is active, what we can relate to either one or several SDGs and indicators, or if there is a country target one way or another that is truly showing an unmet need, and we can put a KPI in place in order to show the company's contribution. That's kind of a hygiene factors for us, and help us to be as concrete as possible, because sometimes you other might get lost in a lot of nice words.
No, that helps, Pia. And well, I'm going to change tack, Jessica, and I want to ask you about the LPs in the Global Impact Fund, your private banking clients, and whether they're ever likely to ask questions about something like impact, which seems quite technical, but I imagine even their understanding of impact investing is growing quickly. I mean, do you foresee a time in the future where having this capability and articulating what that capability is to your own stakeholders, your own LPs, is something that will be differentiating and important for them to understand?
Yeah, and I do, and I think this has evolved greatly. I reflect back on, it's probably at least a decade ago. I can picture like having coffee in San Francisco, my Cambridge days, your PCV days, I think, and I think you were among the first people who were really emphasizing like impact in the sense of like the measurement and outcomes to me, and whether or not we were really taking a look at that. And I think it was early. I think it was a little early in the days. We were just happy there were enough funds that we could diligence, and maybe there was a track record that we could point at. And this has just evolved so greatly since then. I also just more tangibly last week was in a meeting with a group of advisors here internally, and that's sort of a litmus for clients in some cases. But the advisors can be a skeptical bunch, and I was in this meeting with them handling all sorts of questions about various things. And then at one point, they came back again to me to this notion of greenwashing. And I said to them, and I actually have observed this during this 40 minutes or whatever, nobody was asking me about the performance. People were asking me about impact and how they were going to go demonstrate to their clients that we were doing this with a high degree of integrity and avoiding greenwashing. And so I truly believe that, people want to know about performance. And we haven't talked about that in this call. And it is something that our clients expect from us, and this vehicle is set up in that kind of desire to achieve market rates of performance or better. But I think that we are going to be held to a high bar for demonstrating impact. And a good way to describe that is the inputs and the due diligence. And so that's where impact comes in and is really relevant. So we can describe how we chose these vehicles. And then as you well know, as part of this, we've committed to that measurement component. Coming back to our early conversation over a decade ago, you cannot get away with this anymore to just say we did good diligence, believe us. And so we're going to hold ourselves to some annual reporting around impact for the vehicle. So our LPs can stay tuned for that.
Yeah, I was going to ask you, there was a question that came in, Jessica, on that topic of performance monitoring and measurement and reporting. How are you anticipating? It sounds like both Elevar and Trill will have data to share, but how are you imagining, aggregating that at the portfolio level? I know that's a tough thing to do, and it may be enough just to share what Trill and Elevar are providing to you, but are you making an effort to track certain metrics in certain themes? Are you encouraging GPs to try to track the same metrics in the same themes? What are your early hypotheses on how you can do the best job on impact reporting?
Yeah, I mean, they are early hypotheses, but to your point, just gathering a bunch of data and then regurgitating it and whatever we receive is probably not going to be as helpful as us taking on some of the hard work, and it is hard work, you alluded to it, to figure out how to measure in a way that feels like you're at least pooling together some of the underlying impacts in a certain way. Right out of the gate, our LPs have just recently received something from us. That's kind of our first mini report. We don't have much to say. We pointed to the impact of a couple of our co-invests so far, right? And then we promised we'd be back with more on impact. And we've had discussions with the Tideline team to think about what it starts to look like to coalesce around some certain KPIs. And as you know, the impact rubric and ratings itself involved us asking the GPs if they would be reporting on impacts and how. And so we hope to, and maybe this is part of our own continued contribution, to give feedback on what we'd like to see, and hopefully, be part of the entire industry's desire to have a little bit more alignment around certain, KPIs and themes. So TBD, that's our early hypothesis, though, really hoping to put something together that's not just, 8 managers telling us what they did and us having 8 pages of a report, but something a little bit more cohesive.
I think that the tension there, one of our GPs likes to say, I want my companies to be companies and not reporting agencies. And so we don't want to just create, KPI tracking for the sake of it. I think a lot of our GPs are lucky in that there is this demonstrated collinearity, right? You sell more CO2 reduction systems at Nordomatic, and that reduces CO2. That works really well. Obviously, our KPI, from the first bottom line is investment performance. I think that should track well relative to impact, but right, if the companies are having impact, they're also doing well financially, but it's less intrinsically linked. So we definitely want to have some additional KPI tracking. We've asked all the managers to rep to us that they're going to provide that. I think we recognize we're going to need to meet them where they are. And we have this lowest common denominator problem of a portfolio, but it's definitely something we plan to encourage.
Okay. I mean, the natural follow-up question is, having received the impact data, or having collected it in the case, Pia, of Elevar and Trill, to what extent will you be using that data to incentivize employees to ensure that you're meeting the performance goals you've set out on the impact side? I know, Pia, you've tied carry to impact performance. So if you can share in 60 seconds or less how that's working, and then Ami, I'll come to you, and then John, Jessica, how you're encouraging, what your view is on the extent to which you should be encouraging GPs to tie employee incentives to impact performance. So maybe Pia, I'll start with you.
A quick one. Prior to signing, we actually agree with management on 1 or 2 really impactful KPIs that is along with their business and that will be driven by them doing good for their customers. In addition to that, we agree on normally 3 ESG, what I would call internal hygiene factors, which is linked to their own greenhouse gas footprint, gender diversity, and business ethics. But those are really ESG matters. The impact is clearly linked only to that specific company. Those KPIs is linked to our carry, and they're also linked to the bonus of the management team in the portfolio company and the one or two is also linked to the financing of the company, and the footprint, the greenhouse gas footprint, is linked to our credit facility of the fund. So we clearly have built a system of like performance and focus across both our internal team, but also the portfolio companies and our other stakeholders. And that is also what the company is reporting on. We report the impact goals on a quarterly basis, and we've even set for Nordomatic at 2025, and the company has actually pulled that forward to set even a 2030 targets related to this impact and ESG KPIs.
Thanks, Pia. Ami?
We don't technically tie performance to carry around impact because our thesis is so embedded between the two from the core, and we don't have a separate impact team, and this is very much the core of what we do. So the tie is entrepreneur selection and business model selection, because we're the first institutional capital in more than 95% of our companies and often the founding investor. We are taking that bet and that risk to build that alignment through our strategy and our value creation. And so our carry is naturally tied to the performance of the company in partnership of creating that value and setting them up for scalable success.
Great. And John, are you agnostic about it, or are you beginning to form an opinion on incentives tied to impact performance?
I love it. I think two of the 8 managers have a system like that, including Trill. I think we're going to see more and more of it over time. By no means are we requiring that everyone has it, because I think Ami's right. There is this collinearity in terms of what companies are doing with impact. If we didn't believe that, we wouldn't be investing to begin with. And there's a lot of experimentation still associated with those models because they're so new. I'm really excited to see how it works in Trill's case, because I'm sure that come Trill 2, we're going to have to tinker with it and it'll be adjusted. But I do think that's where things are going, and I think it's something that we expect to see more and more over time. Back to the impact tool, and there is this the importance of it is it's a forcing mechanism for mindset and causing you to embrace things in a very visceral way. And so I don't actually think that having an impact associated carry vesting at Trill is going to result in Jan and Pia and the team earning $1 less. I fully hope they make all that money, because that will mean we both had a good financial and a good impact return. But it causes them every day to think about it in a very, very fundamental way, the same way that our managers care about the economic carry. And so it's that forcing mechanism that really excites me.
Mm-hmm. Okay, and we had a question about the design of the impact system and the extent to which it was necessary to create a new bespoke system, and I'll answer that myself by saying that the system is aligned with the SDGs, with IRIS, with the operating principles for impact management, with the impact management project. There's no single pre-existing fund diligence tool that does that, and so it was necessary for JP Morgan to take the extra step to create a tool, Impact, that brought all that together. I think our intention in sharing the case study is that will help others not have to go through all the learning that we had to together, and perhaps there's something in there that other allocators can see as useful in their own approaches. But we just have another 10 minutes, and I'm going to turn it to some final reflections here, and I'll weave in some of the other questions that are coming through, and thank you for submitting them. But Ami, Pia, I'm going to start with you. What's your and Ami, why don't you begin here? I mean, what would be your advice for other GPs that may be finding themselves subject to a more rigorous impact diligence process from LPs? It sounds like practices are developing, capabilities are being built within different allocator platforms. So impact diligence is probably about to become more robust generally. And so, what's your advice for impact GPs?
Maybe this is, I'll take this as my response as someone that's been in the ecosystem for a long time and wants to see the ecosystem continue to evolve. But my advice to GPs would be think very hard about what your strategic position is, what kind of impact you want to create and who on your team is creating it. And then think about how the processes should be developed to align with all of that, because then that makes it a little bit more of a foundational change or practice as opposed to something that's just tacked on or a sort of a side strategy. So long-term building it out as a part of the core infrastructure and seeing those impact DDs that come through, no different than the investment DDs or the operational DDs that we are subject to, but they're all of equal value and should be given equal importance.
Great, thanks, Ami. Pia, what are your what's your advice to other impact GPs?
If I then take the stand of the new fund, as we were a first-time fund and developed everything from scratch, I think what was useful in our case was that we did a number of dry run. First, we look at the flow of available assets in the market to say what kind of deals can we make and how will that flow of opportunities look like, and what will be our DNA with our competence and our view of impact linked to that. So I think to Amy's comment, then be very clear of what you would like to do in terms of impact and what you would not like to do, and be self-confident in that. At the same time, when you meet with LPs, be prepared to talk about your pipeline, not mention the company names, but basically explain what kind of deals you're willing to make and why. You will get good feedback, but you also can practice and understand how you will make the difference. And then I think in our case, we did a number of dry runs, some just through from example companies. We drove from sourcing ID to start to use and develop our own IC material, the combined value creation and impact thesis, the analytics use of and I saw here in the questions around the SASB, the GIN and IRIS, how you would like to integrate those kind of frameworks into your own model, and use best practice, but also stay close to your own strategy and your capabilities and resources you have, and go all the way in thinking of how will that later be implemented and used in the portfolio companies. And when you've done that round a number of times, think about if you can simplify it and make it more relevant for the active ownership that you will take on in the companies, and also how, of course, in the end, how you explain that to the investors. So I would say, as with everything, like practice, think through, go back, adjust, and make things as simple and as understandable as possible, because focus should be on making change, making a difference, rather than elaborate around complicated tools if not necessary.
Great, thanks, Pia. Jessica, John, what's next for the platform? Jessica, you mentioned this might be the first of a family of funds, and I'll weave in a question from Kate Ahern related to other asset classes that theoretically impact could be applied to, and whether you've thought through its application even in a public markets context, for example, or in other private markets asset classes. But would welcome your thoughts on what might be next for the platform.
Yeah, I mean, certainly this is fund one, and expect us to be back. So we are already talking about timing TBD, but thinking next fall for GIF2. So we're really excited about that. I'll note too that from way back in the day, I remember talking to my old boss Kevin Stevenson about this, and a lot of people have a view on wanting to invest in their particular theme. Like a U.S. foundation has a mission, and it's mission-aligned investing for a reason. But I always think that it would be great, and this field would grow a little bit more when people do think about sort of this concept of like cross-pollination of themes. And I think that that's what excited us about creating this in the way we did across 3 themes. Hopefully everybody will find one of their themes in these underlying allocations. And so I think that we have found that we like this approach. We might come back with more other kind of single fund offerings that's certainly still open. So you can expect to see that from us too. But I do think that, you know, this in this form, maybe we'll tinker at the margins, who knows, but I think this will be back in its current kind of form that we have found to be successful and well received by clients in the future. And maybe I'll just quickly take the other great question from Kate on other asset classes. I mean, we haven't specifically planned to take impact in its current form to those other evaluations. Our due diligence teams in the long only and hedge fund space do actually have their own very rigorous ESG surveys that we're you know, enhancing, in the process of enhancing and reissuing out to the market. So there is that. And then also, you know, we're going to be doing a lot with our partners at Open Invest around really thinking and driving towards particular themes. So I think there's a lot that everybody across the platform in their due diligence could benefit from impact, but in its current form, not necessarily being applied to the other asset classes.
Right. John, any final words from you?
The only thing I would say is a little bit of a call to action to any allocators that are, you know, on the line here. You know, it's very daunting to embark on this adventure. You know, we thankfully had some background, you know, single commitments that we made over the years, but it's been remarkable as we built this portfolio, just, you know, getting out in this marketplace and the sheer number of inbounds we've seen as a result of that. And so as I think about, you know, raising a fund 2, fund 3 down the road, making this programmatic, you know, I don't worry at all about the sourcing mechanism. You know, just having this first step has caused this sort of inflow of opportunities, which has been great for us. Really target-rich environment, both in this space, you know, private credit, real estate, on the liquid side, that all of those asset classes, maybe they aren't all right for global impact, but it's just increased the sort of world of opportunities that we're seeing, and that's been just really rewarding for us.
Great. Well, thanks so much, John, Jessica, Pia, Ami, for joining us. Really appreciate it, and thank you to our audience for tuning in. Please do visit us at tideline.com, and we'll look forward to seeing you for the next Compass series of conversations with leaders in impact investing. And bye for now, and thank you again for joining us.
Thank you.
Thanks, everyone.
Thank you, everyone.